Good morning, all of you, dear students. Yes. Yeah. In today's session, I'll start with a new concept. Terminal value method. Or modified NPV. The other name for this terminal value method is modified NPV. You know, for calculating modified NPV, the process is completely different actually. First of all, for calculating modified NPV, we should have cash flows, cash inflows as well as investment. Say investment is equal to 1 lakh and next 3 years inflows are 50,000 each for the next 3 years. Okay, 1 2 3. You know, the cost of capital is 10%. You can easily calculate NPV for this cash flows pattern simply by discounting these cash flows at 10% cost of capital, and by deducting my investment I'll get NPV, right? That's a strike question. But I'm not here to calculate NPV, I'm here to calculate modified NPV. For calculating modified NPV, we need another rate called reinvestment rate. Which rate? Reinvestment rate. Say your reinvestment rate is 8%. See, in modified NPV, I'm just telling you the concept, I'm just telling you the process only, okay? Simply, under modified NPV concept, you should not go for direct discounting straight away. First of all, you should convert all the year's cash inflows into terminal year. Terminal year means project ending. Okay. See here, the terminal year is third year. That's an ending year, right? So convert all the year's cash inflows into terminal year ending by using reinvestment rate. By using reinvestment rate, that means 50,000 into, when I'm converting values into future, I should do discounting or compounding? Compounding. Compounding means 1 plus r whole to the power of n. At what rate I'm telling you to convert all these cash flows into terminal year? Reinvestment rate. Convert all the year's cash inflows into terminal year by using reinvestment rate as a compounding rate. Okay. So the first year ending cash inflows can be reinvested for how many years? Balance 2 years. Second and third year. That means how many years return I should add? 2 years. Which rate? 8%. Okay. 50, yes, reinvestment rate. 50,000 into 1 plus 0.08 whole to the power of 2. Convert this number. 58,000. Okay. Now, the second year ending inflow should be converted into third year ending by using 8% as the reinvestment rate. 1 plus 0.08 whole to the power of 1. 50. Are you getting? Yes. Now the third year ending should be converted into third year ending only. In fact, you don't need to add any return actually. 1 plus 0.08 whole to the power of 0. How much? 50,000. In this way, convert all the year's inflows into terminal year by using reinvestment rate as your compounding rate. Are you getting? So successfully we have converted all the year's inflows into terminal year. Now sum up all these figures. 162. Yes, this is my terminal value. Okay, this is my terminal value. Now discount this terminal value. Discount this terminal value at cost of capital rate. At which rate? 10%. That means simply 1,62,320 into 1 by 1 plus 0.10 whole to the power of 3. Third year ending present value factor. Yes, 0.751. 1. Yes, yes. 162,320 into 0.751. If you take all decimals, you'll get accurate figure. Then I'll get present value of terminal value. Okay. Yes, tell me. My present value of terminal value is equal to. I will write it again. 162,320 into 0.751. This is your present value factor at the end of third year at cost of capital rate. Remember one thing, while discounting, I must use cost of capital only, okay? Under modified NBV method. Yes, tell me. 121,000. 121,953. Are you sure? Minus my investment. Nothing but present value of cash outflows. Today's outflow. 1 lakh. Hello. Then how much I will get? This is my modified NPV, okay? This is my modified NPV. And this method is known as terminal value method. So, under terminal value method, this is a process. What is the process? First, convert all the year's cash inflows into terminal year by using reinvestment rate as your compounding rate. Then you'll get some terminal value. And such terminal value must be discounted at cost of capital. Then you'll get present value of terminal value. From that, please deduct your investment and whatever the value you're getting, which is known as what? Modified NPV. Are you getting? Yes. If this modified NPV is positive, I can accept the project. Otherwise, I'll reject the project. Shall we handle the problem? Yes. Now look at problem number 14. A company is contemplating an investment project of 4 years with an initial outlay of 1,20,000. How much is my investment? 1,20,000. Life 4 years. The cash inflows estimated from the project are 30,000, 40,000, 30,000 and 36,000. How many years inflows? 4 years inflows. The estimated rates at which the above cash flows will be reinvested are. See here the reinvestment rate is not one rate. It is different rates for different years cash flows reinvestment. Okay. The first year ending inflow should be reinvested at 8% rate. And the second year ending inflow should be reinvested at 9% rate. And third year 10%. Fourth year 9%. Actually you don't need to reinvest your fourth year ending inflow. But that's a rate. That's it. Okay. We don't use it actually. What do you say? The cost of capital is 10% per annum. Analyze the viability of the project under terminal value method. Are you getting? Yes. So let me do it. Problem number 14. Yes. Step number 1. My first job is to calculate terminal value. Calculation of terminal value. Calculation of terminal value. How to calculate this terminal value? These are the standard columns. First see the question. Answer please. Focus. Here cash flows. You should know your reinvestment period. You should know your reinvestment period. And you should know the reinvestment rate also, okay? In case if the reinvestment rate is a single rate, you don't need to take this column actually, okay? But see, since the reinvestment rate is changing from 1 year to another year, we have to take this column separately. Reinvestment rate. And the next column is calculation. Please, because you have to convert all the years inflows into terminal year under this column, okay? And finally, I'll get terminal value. Tell me, what are the columns, required columns? Here, cash flows, reinvestment period, reinvestment rate, calculation, terminal value. Yes. How many years? 1, 2, 3, 4. First year inflow. Second year inflow. Third year. 30. 36,000. Next. Okay. First year ending inflow can be reinvested for 3 years. And this is 2, 1, 0. Reinvestment rate for first year ending inflow 8%. Next. Yeah, I'll write it and I don't take it actually. Okay. How much? Yes. Automatically the power 0 becomes 1, right? Yes. 30,000 into 1 plus 0.08 whole to the power of 3. Let me write all the numbers. 40,000 into 1 plus 0.09 whole to the power of 2. 30,000 into 1 plus 0.10 whole to the power of 1. And here it is 36,000 into 1 plus 0.09 whole to the power of 0. Anything power 0? 1. Okay. Yes. 30. 791. 47, 524. 33,000. 36,000. Are you sure about these numbers? Confirm it once. No, this is 33,000. Are you sure? No issue. Confirm these numbers. Okay, then fine. Sum up these numbers. Take the sum. 154,315, and this is my terminal value. Okay. Now in step number 2, I'll convert terminal value at cost of capital rate, right? Modified NPV is equal to present value of terminal value minus initial investment. Okay. For converting terminal value into present value, I must use cost of capital as a discounted. How much is my terminal value? 315. Yes. Into present value factor at cost of capital rate. 10%. Are you sure? At the end of 4th year. Minus my initial investment. Yes. Tell me the present value factor. 154, 315 into 683 minus 1,20,000. Then tell me. 14,603. What is this? Modified NPV. Yes. So successfully we have calculated modified NPV. And this is also known as what? Terminal value method. What do you say? Any doubts? Yes, yes. Are you sure? Copy the solution. Okay. See, why we are following this process? That's a question, right? Modified NPV. Why should we understand this concept modified NPV? 1, 2, 3. I'm taking the same example. 3 years inflows I'm taking, okay? 50,000 each year. Generally, for calculating NPV, I'll follow direct discounting. That means I'll straight away discount the cash flows and deduct investment to get what NPV. But in reality, that is not the way to calculate NPV. The real way to calculate NPV is, first you should convert all the year's inflows into terminal year by using cost of capital as a reinvestment rate. By using cost of capital as a reinvestment rate. That means our assumption is I can earn the same rate of return which is being expected by my long-term investors. My long-term investors are expecting 10% rate of return from the project, right? So at that rate only I can reinvest my cash inflows from the project. That means generally in regular situation, I'll reinvest these cash inflows at cost of capital. 1 plus 0.10 whole to the power of 2. Please calculate it. 58,000. And this second year inflow, again at cost of capital. 50,000 into 1 plus 0.10 whole to the power of 1. That's okay, no issue. 60,000. Then this is 55,000. Then third year running inflow, 50,000 into 1 plus 0.10 whole to the power of 0. I'll get 50,000 only. Sum up all the numbers. 165. Actually, my first job is to convert all the year's inflows into terminal year by using cost of capital as a reinvestment rate. See, I'm just talking about NPV only now, okay? Not modified NPV. This is the process of calculating NPV. Yes. Now you got terminal value. Discount this terminal value at cost of capital again. 10%. That means 1,65,500 into 0.751. If I'm not wrong, right? Third year ending present value factor. Then I'll get present value of terminal value 1 lakh 3. Yeah, 291. Approximately 300, right? Yes. Minus my investment 1 lakh. 24,000. Are you getting? This is my NPV. This is the way to calculate NPV actually. Hello. First convert all the year's inflows into terminal year by using cost of capital as a reinvestment rate, and such terminal value should be discounted at cost of capital again. From the deduct investment, you will get NPV. Instead of this process, I'll follow straight away the direct discounting concept. That means I don't convert all the year's inflows into terminal year and I don't discount the terminal value again at cost of capital. Straight away I'll discount the cash flows at cost of capital. Present value of cash inflows. The regular process I'm telling you, okay? 50,000 into. Since the cash flows are equal, I can use annuity factor. Yes, tell me the annuity factor at the end of third year. 2.791. No. 2.48. Are you sure? Refer the factor tables. You don't have such tables. 2.486. Yes. 124 minus my investment 1 lakh. Then the difference. This is a regular way to calculate NPV, right? Have you observed one thing? I got same numbers. I got same numbers, right? See, in the first process, I've converted all the year's inflows into terminal year by using cost of capital as a reinvestment rate. Again, discounting such terminal value at cost of capital. I got 24,300 NPV by using such process. And now our regular process also gives us 24,300 NPV only, right or wrong? That means in both the cases I'm getting same NPV. Actually, you're supposed to calculate NPV like this. In which way? converting all the year's inflows into terminal year by using cost of capital and discounting such terminal value at cost of capital. Instead of that, we are straight away discounting the cash flows and getting NPV, right? So why you are doing like this? Generally, this is the true way to calculate NPV, but this is a somewhat cumbersome process. That means a complicated process. Unnecessarily, we are converting all the inflows into terminal year and again discounting such terminal value at cost of capital. That's a big process actually. Instead of that, you can straight away go for direct discounting process. Till now, we have followed in all the problems, right or wrong? And even in future also, I'll straight away discount the cash flows whenever I want to calculate NPV. I don't convert all the years inflows into terminal year by using cost of capital as reinvestment rate. Again, discounting such terminal value again at cost of capital. I don't follow that process. Why, sir? Simple. You know, have you observed one thing? I'm adding 10% rate of return for the reinvestment period and again discounting such terminal value at cost of capital only. That means I'm adding 10% and I'm deducting 10%. Do you know one thing? Compounding means addition of interest. Discounting means deduction of interest, right or wrong? Here I am adding 10% rate of return and again I am going to deduct 10% rate of return. That means the reinvestment rate is cost of capital and the discount rate is also cost of capital. So whatever the rate of return you are adding through reinvestment process, that will be deducted by discounting process at the same rate, cost of capital. Are you getting? That means the rate of return which you are adding will be completely adjusted by a set off by discounting such terminal value at cost of capital, so that the reinvestment impact becomes zero. The reinvestment impact becomes zero actually. Okay. The reinvestment impact becomes zero actually. The reinvestment impact becomes zero. Straight away you can go for direct discounting, because whatever the return you are adding, again you are deducting such return by discounting. How much return you are adding? 10%. How much return you are deducting? 10%. Through reinvestment you are adding 10% return, and through discounting you are deducting 10%, so that the impact of reinvestment becomes zero. Only the direct discounting impact will be considered. Are you getting my point? So that's why whenever I'm calculating NPV, I don't go for reinvestment and I don't discount the terminal value. Instead of that, I'll straight away discount the cash flow set cost of capital. Are you getting my point? See, simply understand one thing here. See, how much return I've added? 50,000 into 1 plus 0.10. See, simply my job is to discount the cash flows, right? At 10% rate of return. This is the way. Say for example, if I follow the traditional method, that means converting all the years inflows into terminal year and discounting such terminal value at cost of capital. What you have to do? Let us handle only 1 year inflow. Which inflow? First year ending inflow. How much return I should add for converting this first year ending inflow into third year ending? 2 years return I have to add, right or wrong? That means 1 plus 0.10 whole to the power of 1 plus 0.10 whole to the power of 2. So that this 50,000 will be converted into which year ending? Third year ending. And then such terminal value should be discounted at 10% rate of return, right? That means 1 by 1 plus 0.10 whole to the power of 3. Are you getting? And now cancel these terms. 1 plus 0.10 whole to the power of 2 should be cancelled here, right? Then I'll get 50,000 into 1 by 1 plus 0.10 whole to the power of 1. That means that the converted third year ending inflow again converted into first year ending. Because whatever the return you are adding, again you are deducting by using the same 10% rate of discount. So that again my inflow will be converted into which year ending? First year ending. And such value should be discounted at 10%. That's what I'm doing here, right or wrong? Are you getting my point? So the rate of return I'm adding should be deducted by discounting. So the impact of reinvestment becomes zero. There will be only direct discounting. 50,000 into 1 by 1 plus 0.10 whole to the power of 1, which means present value of which year ending inflow? First year ending inflow. That means I'm just considering, am I considering reinvestment and discounting? No, straight away I'm taking first year ending discounting. Are you getting my point? So the impact of reinvestment becomes zero. It will be nullified. It should not be considered. You don't need to consider it. Are you getting my point? Yes. For that reason only, whenever I want to calculate NPV, I'll straight away discount the cash flows by multiplying the respective year's cash inflows with the present value factors at the end of the respective years at which rate? Cost of capital. I'll never convert all the year's inflows into terminal year, and I'll never discount the terminal value again at cost of capital. Straight away, I'll discount all the year's future years inflows into straight away I'll discount all the years future cash inflows at cost of capital only. Are you getting my point? But my point is, in case if I'm not able to reinvest my cash flows at cost of capital rate, that means my reinvestment rate is not cost of capital. When I was not able to reinvest my cash inflows at cost of capital, that means my future reinvestment rate is changing. My future reinvestment rate is changing. That means 8% I'm taking. How much rate I'm taking? 8%. You know? Now this time, let me write the numbers. 50,000 into how much return I should add? I'm not able to reinvest my cash flows again at 10% this time, right? That means I'm not able to reinvest my cash flows at cost of capital. I'm able to reinvest my cash flows at some other rate that can be less than cost of capital, or that can be more than cost of capital. Sometimes that can be equal to cost of capital. If it is equal to cost of capital, then straight away I can calculate NPV. But the point is, this is not equal to cost of capital. This time this is equal to 8%, which is less than cost of capital. Yes, I should add 8% rate of return for the balance 2 years, right? I'm talking about first year ending inflow to your students. Power 2. Power 2 into, then that will be converted into third year ending. And I should discount the terminal value at which rate? Cost of capital into 1 by 1 plus 0.10 whole to the power of 3. Now can I cancel these terms? No. That means I cannot cancel these terms because I'm adding 8%, but I'm deducting 10%, which will never be equal to direct discounting based NPV, right? Are you getting my point? That means when your reinvestment rate is not equal to cost of capital, when your reinvestment rate is not equal to cost of capital, you cannot simply say the reinvestment impact is completely adjusted by discounting, because your reinvestment rate is 8%, whereas your discount rate is 10%. When both of such rates are not same, you cannot simply directly go for calculating NPV under traditional method. That means you cannot simply calculate the NPV by using direct discounting concept. Are you getting my point? If you want to go for direct discounting concept, definitely the reinvestment rate should be equal to cost of capital. In case if your reinvestment rate is deviated from your cost of capital, then in that case, you don't have any option. Don't go for direct discounting. Convert all the years inflows into terminal year by using reinvestment rate and discount the terminal value at cost of capital and get the NPV, and such NPV is being modified. That's why that is known as what? Modified NPV. Are you getting my point? So modified NPV calculation is required when my reinvestment rate is more or less than cost of capital. Are you getting? This is the reason why we are calculating modified NPV. In case of your reinvestment rate is exactly equal to cost of capital, then you don't need to calculate modified NPV. I can straight away calculate direct discounting based NPV. Are you getting my point? Yes, this is the reason why we are learning the concept modified NPV. Okay. The next concept is internal rate of return. IRR. You know, I'm taking one example to understand this IRR concept. A project with a life of 1 year, and I've invested 1 lakh rupees in it. How much I've invested on this project? At the end of first year, I got 1,15,000 cash inflow, and my salvage value is 0. Okay. So how much I've invested? 1 lakh. At the end of first year, how much I got? 1,15,000. Yes. Do you know how to calculate NPV for this project? Yes. But you should need what? Cost of capital. If I take 10% cost of capital, can you calculate NPV? Yes, please calculate NPV and say me. 4,000. Yes. This 4,535 says this cash inflow has such a capacity to recover my cost of capital or also my investment. That means this cash inflow of 1,15,000 is loaded with my minimum expected return of 10% cost of capital, which is the expected return of long-term investors, and my investment of 1 lakh. Still it is generating some extra inflow, that is 4,535 in present value terms. Are you getting? So NPV is a testing measure. NPV is a testing measure of every project, whether such projects cash flows were able to cover our expected return along with our investment or not. That's what we are checking. In case if our NPV is positive, then that means that such project has such a capacity to recover our investment along with what? Cost of capital. If NPV is positive, that doesn't mean that we are just earning 10% rate of return only. Actually, in every project, whatever the return we are expecting is known as what? Cost of capital. That means 10% is the rate of return we are expecting, but the project may give you some other return. How much return I am expecting? 10%. And I have calculated NPV and that is positive. And that means I can say this project is giving me 10% return and also it is generating some extra positive NPV. If this 10% is not the return which is completely given by the project. Why? Because this 10% is my expected return, but not the return which is actually earned by this project. How are you getting? That means NPV is a testing measure. That means whether I am able to cover my expected return, whether I am able to cover my expected return from the project's cash inflows. That doesn't mean that I'm just earning 10% return only from this project. I tested that this project was able to cover my expected return of 10%. In fact, it is generating more return. That's why my NPV is positive. Am I right or wrong? Now, the question is, how much return this project is generating? That's the question. How much return this project is generating? If you can calculate such return, then such return is internal rate of return. Internal rate of return means the rate of return that is being included in your future cash inflows along with your investment. Along with your investment, the rate of return that is not your expected return. That is the rate of return which is given by the project. That is the rate of return which is given by the project. That can be more than cost of capital or less than cost of capital. Sometimes can be equal to cost of capital also. Are you getting my point? Now I can say simply, I've invested 1 lakh rupees and at the end of first year I'm getting 1,15,000. Anybody can say this 1,15,000 is loaded with two components. One is my investment of 1 lakh along with the return of, don't say in percentage, along with the return, that is nothing but what? Profit, right? Profit of how much? 15,000. Yes, 15,000 profit, right? Convert this profit into percentage. Convert this profit into percentage, which is known as what? Internal rate of return. Are you getting? Can I say like this? In every project, don't stop your calculation and listen. Okay. In every project, your future cash inflows are loaded with two components: investment plus profit. Investment plus, such profit is technically known as IRR. Such profit is technically known as what? Can I remove such profit from the future cash inflows? Yes. Can I remove such internal rate of return, that means IRR, from the future cash inflows? Yes. By discounting. By discounting. If I discount the future cash inflows at IRR, then the profit will be eliminated, right? This profit will be eliminated. Then what I'll get? That means if you can discount your future cash inflows at IRR, then the profit portion in the future cash inflows will be fully eliminated. Then whatever the present value of cash inflow I'm getting should be equal to my investment. What do you say? What do you say? Yes. Why? Because my future cash inflows are loaded only with two components. One is investment, another one is what? IRR, profit, which is nothing but IRR. And discount the cash inflows at IRR, remove such IRR and get the investment, and such present value of inflow should be equal to my investment, and there my NPV is equal to 0. Are we getting? Yes. Now, prima facie, one can easily say this cash inflow is loaded with 15% rate of return because it's a single year inflow, right or wrong? Yes, 1 lakh plus 1 lakh into 15%, 15,000, 1 lakh 15,000, am I right? Yes, yes. Now, the point is, if I discount this 1,15,000 inflow at what rate? IRR rate. Do you know that rate IRR? 15%. 15% is my IRR, right or wrong? If I discount this inflow at IRR rate, definitely the present value of inflow should be equal to my investment, right? 1,15,000 into 1 by 1 plus 0.15 whole to the power of 1, and that should give me 1 lakh present value of inflow. And don't say me any other number, okay? Present value of cash inflows is equal to, that's why I'm telling you, 1 lakh, right? First of all, actually the cash inflow is 1,15,000, but after discounting, how much I got? 1 lakh. How much amount have been deducted? What it means? What I've deducted the profit portion, which is known as IRR. That means if you discount the cash inflows at IRR, the return will be eliminated. Then what you will get finally? My investment. If I deduct my investment from this present value of cash inflow, then my NPV should be equal to 0. This is my NPV. It is equal to 0. That means at IRR discount rate, NPV should be equal to 0. Then that means IRR is the discount rate. IRR is the discount rate at which present value of cash inflows should be equal to my investment. The biggest question is, why the present value of cash inflows are equal to investment? Because I know that the future cash inflows are loaded with two components. One is investment, another one is IRR. If I remove such IRR through discounting, definitely the present value of cash inflows should be equal to my investment. If at all, if your present value of cash inflows are not equal to investment, that rate is not your IRR. That rate is some other rate, right or wrong? That can be cost of capital or some other rate, right or wrong? So only by discounting the cash inflows at IRR, you can simply completely remove your complete rate of return. Then you'll get what? Present value of inflow should be equal to my investment. Say for example, instead of discounting this 1,15,000 inflow at 15% rate of return, if I discount this 1,15,000 cash inflow at 12% rate of return, do you think that present value of cash inflows is equal to investment? What it means? That means my rate of return is not 12%, right? In case if you discount this cash inflow at 12% rate of return, you'll get positive NPV. That means you have not able to, you are not able to recover you are not able to completely remove the full rate of return which is included in your cash inflow. You just removed only 12%. In fact, you are supposed to remove 15%. Are you getting? If you can't remove the complete rate of return from the future cash inflow, then the present value of cash inflows never be equal to investment. If you really wanted to equate your present value of inflows with investment, then please try to remove the complete rate of return from the future cash inflows, which is known as what? IRR. Are you getting? Yes, prima facie by seeing this cash inflow, I can say 15% is my IRR because it's a simple single year inflow. That's why I simply calculated IRR and that is 15%, and I have discounted this inflow at 15%, then present value of inflow is equal to my investment and the NPV is equal to 0. Yes, now from this IRR is a discounted at which present value of cash inflows is equal to investment, then that means present value of cash inflows minus investment is equal to 0. That means my NPV is equal to 0. So what is the conclusion? At IRR, my NPV is equal to 0. If NPV is not equal to 0, then that is not your IRR. Yes. So IRR is the rate of return which is generated from the project. IRR is the rate of return which is given by the project. That is not your expected rate of return. What is the objective of NPV? NPV's objective is whether the investor's expectation has been covered through the project's cash inflows or not. That's what you're checking by calculating what? NPV. From NPV, you're not even calculating, you're not calculating the return which is generated by the project. You're calculating whether the expected return has been covered by that particular project's cash inflows. Whereas IRR's objective is completely different. IRR's objective is whether the project is generated, IRR's objective is completely different. IRR's objective is how much return I'm getting from the project. You are calculating. Are you getting? You are not testing. You're not testing, you're calculating. What you're calculating? How much return I'm generating from every project. From every project. That's what IRR. Are you getting? Yes. NPV is a testing measure, whereas IRR is a simple calculation, how much return I'm generating from the project's cash flows. Okay. The biggest question is, I know the difference between IRR and cost of capital. What is IRR and what is cost of capital? Cost of capital is a liability side discussion. Cost of capital is a liability side discussion, which is the expected return of all the long-term investors, equity shareholders, preference shareholders, and debt holders, right? Whereas IRR is the rate of return which is generated from the project. That is an asset side discussion. That is an asset side discussion. IRR is the return which is generated from the project. Cost of capital is the expected return of long-term investors. Are you getting? Now, the biggest question is how to calculate this IRR. How to calculate this IRR? Every time the project life is not equal to 1 year, and every time you cannot simply say the rate of return by merely by saying the cash inflow, because there will be number of years for different projects, and your cash inflows will be sometimes can be equal, sometimes can be unequal. You cannot simply say IRR is equal to so much, so and so percentage. You have to calculate it accurately, right or wrong? IRR's calculation is based on two situations. If the cash flows are equal, and the second situation, if the cash flows are unequal. If the cash flows are equal, in case of equal cash flows, I must use annuity method. I must use for calculating IRR, okay? If the cash flows are unequal, I must use trial and error method. Trial and error method. I'll explain these methods when we are handling the problems, okay? Yes. There is no single formula for calculating IRR. Please remove your wrong notion. Some of the students may think that there is a formula for IRR. No, there is no formula for IRR. That's a concept, okay? And you have to calculate it. It is based on the nature of cash flows and some other factors also. Is it clear? So many factors are required for calculating IRR. Yes. It changes from one situation to another situation. Yes. Now, every capital budgeting technique must be useful for taking decisions, right? NPV is positive. If NPV is positive, I'll accept the project. Negative, reject. Equal to 0, may or may not accept the project. In the similar way, even IRR must be useful for taking decisions. If IRR, the rate of return which is generated from the project, is more than expected return, which is, then accept the project, okay? If IRR is less than cost of capital, then reject the project. If IRR is equal to cost of capital, may or may not accept the project. May or may not accept the project. Okay. Yes. Please do one thing so that I can teach you how to calculate IRR. See, for problem number 15, please calculate NPV for project 1 and 2. Okay, please calculate NPV for project 1 and 2. Then we'll go for calculating IRR. Okay, it's a case of unequal cash flows actually. I'll explain. Can you handle it? Yes. 15. Calculate NPV for project 1 and 2 and send me the answers in the next session.